Hey everyone, welcome back to the channel. Today we're tackling one of the biggest questions in finance and real estate right now. Is the housing market about to crash in 2025? You've probably seen the headlines. Housing Bubble 2.0, crash coming this fall, or even it's 2008 all over again. But is that really the case? Or is it media hype? Stick around because we're breaking down real data, economic trends, and historical patterns to see if a crash is truly on the horizon, or if it's something completely different. Why people fear a crash? First, let's understand why so many people believe a crash is coming. Mortgage rates. In 2025, U.S. mortgage rates are still hovering around 6 to 7% after climbing sharply from historic lows in 2021. That's almost double the cost of borrowing compared to just a few years ago. Affordability crisis. Home prices remain at record highs. The median home price in the U.S. is still above $400,000. Combined with high rates, affordability is at its lowest point in decades. Housing inventory. While supply has increased slightly in 2025 compared to the pandemic years, it's still historically tight. This mismatch between high prices and limited supply fuels speculation of a bubble. The 2008 memory. Many people still remember the Great Financial Crisis, where housing prices collapsed nearly 30% nationwide. Any sign of weakness today gets compared to that crash. So the fear is understandable. High prices, high rates, and stretched buyers make for scary headlines. What the data really shows. Now let's look at the facts. Price trends. As of mid-2025, national home prices are not collapsing. In fact, most regions are seeing flat to slightly declining prices. A correction, not a crash. Some overheated markets like Austin, Boise, and Phoenix have seen drops of 10 to 15%, but nationally it's nothing like 2008. Mortgage defaults. Foreclosure activity has ticked up, but it's still well below pre-2008 levels. Why? Because lending standards have been much stricter since the last crisis. Most homeowners today have strong credit, locked-in low rates, and significant equity. Housing supply. In 2008, we had a glut of overbuilding. Today, the opposite, a housing shortage. According to Freddie Mac, the U.S. is short 3.8 million homes. That shortage creates a floor under prices. Unemployment. A housing crash usually requires widespread job losses. But as of 2025, U.S. unemployment is still relatively low, even if wage growth is slowing. That's keeping forced sales down. So while conditions are tough for new buyers, the structural data doesn't point to a free fall. Why this isn't 2008? Let's make something clear, 2025 is not 2008. Back then, you had subprime mortgages given to almost anyone. Adjustable rate loans resetting overnight. Banks collapsing under toxic mortgage-backed securities. Today, lending is tighter. Buyers are better qualified. And most homeowners refinanced into ultra-low fixed rates during 2020 to 2021. That means millions of Americans are paying 3% mortgages while home values have doubled since they bought. Even if prices dip, they're not walking away. So instead of a collapse, experts say we're more likely in a period of stagnation, where prices cool, inventory slowly builds, and affordability remains a challenge. Risks to watch in 2025. That said, there are real risks that could push the market down further. High interest rates staying longer. If the Fed keeps rates elevated into 2026, demand could shrink further. Job market weakening. If unemployment rises above 6 to 7%, forced sales could increase. Regional bubbles bursting. Some markets are overvalued by 30–40%. Those could see sharper corrections than the national average. Investor pullback. Institutional buyers and Airbnb investors have propped up markets. If they sell, prices could dip more. So while a nationwide crash seems unlikely, local downturns are very possible. Opportunities for investors. Now let's flip the script. If you're an investor, this environment can actually be full of opportunities. Cash buyers. With high rates sidelining many, cash investors face less competition. Rental demand. Because people can't afford to buy, rental markets remain hot. Investors can benefit from rising rents. Discounts in overheated markets. Places like Phoenix or Boise might offer deals at 15 to 20% off peak prices. Creative financing. Seller financing and rent-to-own deals are becoming more popular as buyers look for ways around high rates. Remember, wealth is often built in downturns, not booms. So, is the housing market crashing in 2025? Not really. It's cooling, it's correcting, and it's definitely not as affordable as we'd like. But the structural shortages, strong lending standards, and solid job market mean it's not 2008 all over again. If you're a buyer, be patient but prepared. Deals are out there, especially regionally. If you're an investor, focus on rentals and long-term strategies. And if you're just watching from the sidelines, don't let fear headlines trick you into thinking the sky is falling. Now I want to hear from you. Do you think housing is in a bubble right now? Are you waiting to buy or investing through the storm? Drop your thoughts in the comments, hit like if this helped, and don't forget to subscribe for more deep dives into real estate, finance, and investing. Thanks for watching, and I'll see you in the next one.